Everyone's favorite CCP whipping boy Ray Dalio is back, and actually he never left. He's always been publishing stuff, but I love to check in to see what he's talking about as long as it doesn't relate to China. Actually, even if it relates to China, I still like to read about it. Because even though he's a CCP cuck, he still has great information. He's one of the greatest investors who ever lived, especially when it comes to macro. You can't beat it, so it pays to pay attention to him. Now, in one of the latest research articles that he released, he talks about bubbles. Because one question we gotta ask is what we were seeing in the last few years, was that a bubble? Now, of course, a lot of people would say, yes, of course it was a bubble. But again, those same people have been saying we're in a bubble since 2009, since the last bubble popped. So the word bubble, as we know, gets thrown around a lot, which is why it's better to pay attention to someone like Dalio, who has the actual data analysis power to see whether we actually were in a bubble and where we are now. So Dalio defines a bubble market as one that has a combination of the following factors in high degrees. And there's 6 factors here that we'll go into detail in a second, but here's a broad overview. So the first thing you gotta look for in a bubble is high prices relative to traditional measures of value. So what he does is he takes the present value of a company's cash flows and then compares it to their interest rates. So as you'll see below, you could do this with multiple different assets and companies and then put together an aggregate reading. Another thing you gotta look for in a bubble market is unsustainable conditions. So this once again is related to a company when you start extrapolating their past revenue and earnings growth rates late in the cycle. So okay, a company has been growing really well and analysts think it's going to keep growing at that pace, even when there's capacity limits, which means that growth can't be sustained. And that leads well into what we always talk about on this channel, which is expectations, because markets are driven off of investors' expectations. Now this applies to the general market, like if we're thinking macro, like, oh, investors think inflation is coming, so they think the Fed is going to raise rates, so you see the market fall. Did inflation actually come? It doesn't matter. What matters is if investors think it's going to come, because the market is a future pacing mechanism, so it's always looking into the future. What's happened now or in the past is already priced in, so it's more expectations about the future. And that same concept applies to companies, especially in growth stocks. Because here's the thing with growth stocks, the actual number of, see, what their earnings were, it doesn't matter from quarter to quarter. What matters is what were investors expecting that company to grow at, and whether that company beat those expectations or fell below them. So say analysts are expecting this hot tech company to grow at 50% this quarter. Well, even if the company comes in at 49%, which is still amazing, you'll probably see that stock price plummet. Even if the company comes in at 50%, which is what was expected, you'll see the stock price plummet. Because what investors want is for their expectations to be exceeded. So for that company's stock price to go higher, it would have to come in at 51%, 52%. Then investors are surprised and they're like, oh, this is amazing, and you'll see the price shoot up. And you can see how this becomes difficult and it's unsustainable because quarter after quarter, if a company needs to surprise, there's only so much you can grow. And especially if you're expected to grow at an exponential rate, it is unsustainable. And that's why you see the bubble form, because the expectations of these investors price this company way out into a perfect future. For example, Tesla. Like Tesla was priced as if it was going to take over the entire world, even the entire universe. So as soon as those expectations start to falter, you'll see stocks just crater. So when we're talking about bubbles, that's what creates bubbles too. That's a huge factor. Just these expectations. So when Dalio is talking about unsustainable conditions, he's focused more on the company, extrapolating revenue and earnings growth. But you also got to think about investors in that too. But moving on, the third factor is many new and naive buyers who are attracted in because the market had gone up a lot. So it's perceived as a hot market. Now we all know what happens, right? The market looks good, a bunch of fools rush in. Classic. And part of that is factor number 4, broad bullish sentiment. Everyone sees everyone else making money, everyone jumps in. Put all their money into the market. Number 5 is a high percentage of these purchases being financed by debt. Because hey, if you didn't have a lot of cash, but you're seeing everyone make a ton of money and it's super easy, you just throw it in and it goes up, what are you gonna do? Hey, I might as well borrow money and make a bunch of money on money I don't even have, because hey, I could pay it back and it's all gonna go great. And this is what also causes a bubble, because as investors get out over their skis, and this is a term that we use a lot, it means that they're using debt, which is money that they don't have, to finance purchases. So what happens if stock prices stop going up? As soon as it turns around, these investors that are investing based off debt, they are the most fragile, the weakest hands, and they sell like crazy. So that accelerates the downside. because they're working off debt. So just like debt can fuel that bubble up fast, it can bring it down even faster, which is exactly what happens in every single bubble. So one thing you want to look at is how many purchases are being financed by debt. As that number goes up, that tells you, hey, we're in a bubble. The sixth thing he looks at is a lot of forward and speculative purchases made to bet on price gains. So this is once again kind of looking at companies, so inventories that are far more than needed and contracted forward purchases and things like that. So basically companies planning into the future and almost overspending, because you have the consumer side and then you have the company side too. So those are the 6 factors that we're looking at in a bubble. Now the question is, were we in a bubble just recently? And is it popping right now? Well, in January, the bubble indicator that Dalio has showed that the US equity market as a whole was at the edge of a bubble, but not in an extreme bubble. So what he's doing here is comparing our current conditions to 2 previous bubbles, one in the 1990s, the tech bubble, and another one in the 1920s. So by comparing what's happening now and then, you could see where we are. So this recent bubble, and yeah, we could call it a bubble, was 70% of the way towards the highest bubble, which happened in the late 1990s and the late 1920s. So some emerging tech companies like Tesla and Roku were clearly in an extreme bubble. So on a case-by-case basis, yeah, some stocks were in extreme bubbles. And those are some of the same stocks that we saw drop 90%. In the previous video, I was talking about companies like DocuSign. Just absolutely crushed, everything in Cathie Wood's portfolio. Those big tech story stocks that everyone thought were gonna grow forever. And the ones that were fueled by all the new people coming into the market during the pandemic and running those prices up. There's also other bubbly behavior during that time. So we had SPACs, we had the IPO boom, we had the huge pickup in options activity. If you've been watching these videos for a while, we used to track that. So all of this was financed by the unprecedented flood of liquidity post-COVID, and that found its way into asset markets. We create our own bubbles, don't we? Well, of course, how else would a bubble be made? So Dalio basically created an index of the stocks which he called bubble stocks, but since that time, those bubble stocks have popped. Obviously, they're down, like I said, like 90%. Well, some of them anyway. As a whole, according to Dalio's indicator, they declined about 1/3, while the S&P was about flat, relative to his indicators anyway. So that coupled with other developments in the market, including a meaningful decline in frothy retail activity and a meaningful deterioration in sentiment. So those factors combined show that emerging tech stocks are no longer in a bubble. But they also haven't swung to the opposite extreme, which tends to happen when a bubble pops. So now is not necessarily a good time to jump in the market. And we've talked about this a lot in the recent market reviews, but it's good to get other people's opinions too. Especially someone like Dalio, who is legit, has the actual data backing it up. And you'll see a lot of similarities between what he's saying and what we've been tracking too, which is good. So the reason why he's saying it's not necessarily a good time to buy now is because bubbles can take a long time to unwind. So in the case of the 1929 bubble, it took 2 years. And in the case of the 90s tech bubble, it took a year. And what happens is we typically go to the opposite extreme. So we get that bear market, we get that crash way lower than it should. Because just like there is extreme euphoria that created the bubble, you get extreme pessimism that pushes stock prices below their fundamental value. And that's when you get the good deals to back up the truck. Like we were talking about that one stock in our last video. Not even going to tell you the stock because you'll know it if you watch the video. I'll put a link to it at the end of this video. So just because we aren't at a bubble extreme doesn't mean that it's safe or a good time to get long. In fact, US stocks in aggregate still look overvalued by Dalio's measures. And this article was from a few weeks ago, so we got to take into account how much the market has dropped from then until now. And according to our research at MacroOps, we actually are nearing the bottom. But this is still good to review because this is the right way to look at valuations. And it's good to compare it to the 90s and the 20s. So these 3 charts are interesting because here is the bubble indicator, and you could see in the 1920s it popped up to 100%. 1990s, 100% as well. But today it only went up to about 80%. So again, like Dalio said, this is not the most extreme bubble. And you could also see it came down. So it's not as extreme as these other ones, but it is indeed popping. Here's an aggregate of the most bubbly companies which Dalio was tracking in 2020. Well, he defined them in 2020. You could see they came down significantly. Like we were saying, all those big stocks down 90%. This is another way to look at it. Those bubble stocks are the red line right here. They've come down a lot. They've given up most of their post-COVID gains. And total returns of that bubble slice are negative. Real bad. So hopefully people did not try and buy and hold those stocks. Trading is the way to go with these bubbles. So here's an interesting set of charts too. You got the 1920s bubble right here. You can see that the decline in interest rates actually fueled the bubble in asset prices. The red line is the S&P, the blue line is long rates. And then as rates started to go up, That's when the bubble popped. So easy monetary policy creates a supportive backdrop for growth equities. And another thing you could see is that margin debt fueled this bubble as well. These are people taking on debt to buy the stocks because everyone else is. Looks so easy. 1990s bubble, you see the same thing. Short rates came down, the market exploded, and then as soon as they came back up, you had the bubble pop. You can see again, debt buying occurred at the same time. This blue line is the high margin debt, and this red line is equity call volume, so lots of options. And this is the 90s bubble, right? So there's elevated retail flows and levered buying, driving prices higher and higher. And we're talking about equity call volume as debt because you can basically consider options as levered plays, right? You get higher upside and lower downside depending on how you're doing it. Now, if you look at today, once again, rates went lower, the bubble formed, rates are going higher, and now it's popping hard. And we see this same thing with equity call volume and margin debt, which are now declining, but they fuel the way up. So tightening liquidity eventually pops the bubble, although this often follows through with a lag. So it's not perfect. Stock prices usually follow. So everything we've been seeing that's driving this current bubble is classic. It's the same drivers we saw 100 years ago in the 20s and the same drivers from 20 years ago in the 90s bubble. We've seen the tightening, right? It has pricked this bubble. But now if you look at Dalio's readings, it looks like we're out of the bubble. So it has calmed down. You can see everything is deflating. One factor is somewhat frothy, but the rest are coming down. So now let's jump into these 6 factors and define them better and see where we are. This is a good framework to determine when we are in a bubble. So first thing, how high are prices relative to traditional measures? So the current reading for our stock market is around 50%, so it's coming down. Again, you can see here in the 20s and the 90s, it was up to 100%. We never reached that. We got close, maybe about 90, but we weren't there. But you can also see how much it deflated, right? And if we're only around 50%, we might have some ways to go, which is what Dalio was saying about how bubbles, they overcorrect the other way. When you're at the zero indicator, you're gonna get some real deals in the market because that's when the stocks are pushed way below their actual fundamental value. Or there's no such thing as actual fundamental value, but what sober investors would think is the actual fundamental value when they're not scared and selling everything. Second factor, are prices discounting unsustainable conditions? So this again is the earnings growth rate of a company that's required to produce equity returns in excess of bond returns. Now currently this indicator is around the 60th percentile for the aggregate market, which is more elevated than some of our other readings. So the earnings growth discounted in stocks is still a bit high, which means that analysts need to revise lower. And companies need to revise lower too. So there's still some froth here. So this needs to come down. And that's absolutely going to come down as the bubble keeps popping. And this is even more noticeable in the US software sector. Analyst earnings growth expectations for this sector have come down, but they're still relatively high compared to history. Like the PEs have reversed their COVID gains, but again, still high compared to history. So they too need to come down. Valuations aren't completely reset yet. Third factor, how many new buyers, those who weren't previously in the market, have entered the market? Now we know absolutely that happened in 2020 during the pandemic. Everyone was trading, but it also happened in the 1990s when trading online was first becoming big, and it even happened in the 1929 bubble. So this always happens. It's a big factor. The suckers flooding in. So this gauge shot above the 90th percentile in 2020 due to a flood of new retail investors into the most popular stocks. We all know about that. AMC, GameStop. Oh, it was so much fun. So based off that measure, we were for sure in a bubble, which you can see here. It's almost hitting that 100 percentile. But we've seen a meaningful moderation in the pace of retail activity in markets. And now it's back to around pre-COVID averages. So it's come down a lot. That's the benefit of everyone losing a bunch of money, is all the suckers get washed out. Things get a lot more quiet. You guys have been commenting on the YouTube channel that there's a lot less gurus out there, and that's great. I'm happy because there is always too much noise in the market as it is without more and more people talking. You guys like these little sunspots? I can barely see. If I move my eye a certain way, it starts to blind me. But then if it wasn't sunny, I'd be complaining anyway. Can't win until you fix your perspective. That's your life lesson for the day. Just be happy. But anyway, going back, what is factor number 4? How broadly bullish is sentiment? Because hey, the more bullish the sentiment, the more people have already invested. So they are likely to have fewer resources to keep investing and are more likely to sell. And we've said this in almost every single market review. How does sentiment work? If people are too bullish, they have all their money in the market already, so what's left to buy? They don't have any powder on the side, right? All they could do at this point is sell, which is why a super bullish reading is actually bearish for the stock market. And the opposite is true too. When people are super bearish, they have a lot of cash on the sidelines. So there's only one place for that cash to go, right? Back into the market. And that's where you'll get the buying pressure to push stock prices higher. So that's how you track sentiment. And sentiment in the market right now is significantly negative. And you'll see in our market review on Tuesday that we are getting closer and closer to that point of pure total capitulation. We had to have that brutal selling day after day for it to happen. And that capitulation, when everyone's like, I'm out, then all the money is on the sidelines, right? No more selling to be done. So you can see the bullish sentiment gauge came down a lot. Factor number 5, our purchases being financed by high leverage. So leverage purchases, like we talked about, make the underpinnings of the buying weaker because that buying that they did is more vulnerable to forced selling in a downturn to cover that bet. So these are not strong hands. These are the weakest of weakest paper hands. Do people even say paper hands anymore? Or is that's a 2020 term? I don't know. But today's leverage meter is showing around 50%, so it's come down. A lot of people have been blown out. And like we talked about in the last few weeks, we've seen some crazy market action because whole entire firms have been blown out. They were over leveraged. It's not just retail investors. Professional firms are doing crazy stuff all the time. Then you see them blow up and you see the market absolutely drop because of their forced liquidations. And that's kind of what we've been seeing. And then the stories come out later, oh, this huge fund blew up. But you'll see it in the market first. That's where you get extreme forced selling. And then we got factor number 6. To what extent have buyers made exceptionally extended forward purchases? So this is easiest to see in commodity and real estate markets where forward purchases are most clear. In equity markets, Dalio looks at capital expenditure. So whether businesses and to a lesser extent the government, whether they're investing a lot or a little in infrastructure and factories and things like that. So what is their capital expenditures? What do they think is going to happen? They're going to invest more if they think things are going to be better. So what you don't want is business extrapolating current demand into strong demand growth going forward. Now this gauge is around the 40th percentile, similar to other gauges, so it's been coming down. The bubble has been popping. So in conclusion, while the reversal has been significant, discounting of future earnings remains somewhat high compared to history. So valuations are still elevated. Now again, this is from a few weeks ago, so based off the recent weeks of selling, we might be closer to that bottom. Valuations are realigned with historical norms. But either way, bubbles more often overcorrect, which is sell off more than the fundamentals would suggest, versus just settling back to normal levels. So that's what we still want to see. Again, we just talked about a stock that we're about to back the truck up on because it has been falling so hard, and it's one of those stocks that's like the baby that got thrown out with the bathwater. Because this business is great and it can be $1 trillion company in the future. And right now it's down over 70%. On the day I released that video, it was down another 15%. Investors are punishing this great stock and great company because it's grouped in with all the other tech stocks. And that's what makes it such a great opportunity. In fact, our team at Macroops have already scooped up some shares and we're going to scoop up a lot more. So if you want to see that story, and you should definitely check it out so you can add this stock to your watch list, click this video right here. And the great thing about that video is I don't have this little sun bar just coming down me. But okay, I'm going to get outside and actually enjoy this sun. You know, get the full sun experience, not just the strip. Maybe I'll strip in the sun, who knows? But I'll talk to you soon. Watch this video.